Hi, I'm John Cornettet, a partner in the law firm of Cornettet, Meyer, Rush, and Stapleton. Today we're going to talk about the Secure Act, which is the new law that applies to the distribution of an IRA to your child or trust when you pass away. So, under the old law, we were allowed to use what was called the life expectancy method. And under this life expectancy method, if you had a 48-year-old child, he or she could take it out over their life expectancy, which would be 36 years according to the table. So the child would take out 136th, 135th, 134th. And as they do, they pay income tax on the IRA as it's distributed. And as you might imagine, when they're younger and they're working, the distributions are relatively small, but as they get older, the divisor gets smaller, so their distributions get much larger. So what would happen is when you died, your IRA stayed in a tax-deferred vehicle for a long period of time and really became a retirement-based asset for your children. If a child took out an extra $50,000 in this third year, they could revert back to the 133rd, 132nd formula. So Congress said, nope, we're not doing that anymore. So for people dying in 2020 and thereafter, we have a new distribution formula. The new law basically requires the IRA to be distributed by the end of the 10th year following your death. So really up to about 11 years. As a result of this new law, it opens up options and opportunities for a trust or a child to take distributions. A child could take a lump sum distribution on the front end. A child could take 1/10 a year for 10 years. They could do ad hoc distributions, or they could do a lump sum distribution on the back end, let it grow tax deferred for 11 years, and then take it all out on the back end. So what's the difference? So imagine you have your medical school child who's not yet a doctor. He or she may want to take it all out while they're in school and have no income, pay the taxes on it because we know they're going to be in a higher tax bracket at some point in the future. Your school teacher child might want to take it out 1/10 a year for 10 years to keep it all in lower tax brackets. Your 60-year-old child might want to do zero distributions for the first 5 years, then take it out in chunks over 5 years to get to age 70, and then start Social Security. So from 60 to 65, there's going to be no distributions. Retire at 65, take it out over 5 years, and defer your Social Security. The child that owns a business or is a doctor or a lawyer in a higher tax bracket, well, they may want to just let it grow tax deferred for 11 years and take it out. It's all going to be in the 37% bracket, but if you paid it to the child, they're also in the 37% bracket because they're high income earners. So with this new law, each child's financial circumstances, tax circumstances, is going to dictate what the right plan is for them. There are exceptions to the 10-year rule. If you die without a beneficiary or you've named your estate as the beneficiary of your IRA, it has to come out in 5 years. If you name your spouse as the beneficiary of your IRA, your spouse still gets the ability to roll it over into a spousal IRA or do the life expectancy method. So when you think of the Secure Act, these rules really apply to children, grandchildren, trust, not to your spouse. A minor child can use the life expectancy method until the age of majority, then they have to convert to the 10-year rule. So if you think about an 8-year-old child, from 8 to 18, they would have the life expectancy method, and then from 18 to 28, they'd have to take it all out over one of those formulas. Interesting enough about the law, this only is available to a minor child. It is not available to a grandchild. A chronically ill or disabled child or beneficiary will be able to use the life expectancy method. And if the beneficiary is within 10 years of the age of the IRA owner, they can use the life expectancy method. This is an example where the brother who's 72 is going to leave his IRA to his 70-year-old sister. She would be able to use the life expectancy method. So now we're going to turn to the Secure Act and how it changes estate planning and the use of a trust. So some of my clients have said, if the IRA has to be distributed over 10 years, do we still need a trust? Shouldn't we just switch it so the children are the direct beneficiaries? And as I think you'll see, the answer is no. Trusts still have value in estate planning and with these new laws. So if you pay it to a child, the child gets to control the distribution plan. So you could have a 32-year-old spendthrift child who says, I don't care what the tax consequences are, take it all out, pay the tax, and then waste the money. Where if it's paid to a trust, the trustee is going to control that child and protect the spendthrift child from spending the money or taking it out in a manner that's not efficient from a tax perspective. If your child is the direct beneficiary, it's not flexible. The only option is for the child to pay the tax. Where if it's payable to a trust, there is flexibility to either accumulate some of those distributions within the trust and distribute some to the child. So we can kind of pick and choose. If a child dies before the IRA is distributed, say the child dies in year 9, the child can leave that IRA to a spouse, a charity, or someone else. Where if the child died in year 9, whatever's left in the the IRA, the trust would dictate. So instead of going to your child's spouse, it would go to your child's children, your grandchildren. There is no asset protection when you leave it to a child. If the child has the right to take it out of the IRA, your child's creditor has the right to take it out. Where the trust would provide asset protection. We'll talk more about that later. And if you leave it to a child, the child could disclaim it, which means pass it to the grandchildren. But in a trust, we can do a disclaimer or a spray provision or a spray power. So we'll talk about that also in greater depth. So trusts are still valuable in estate planning and the use of receiving the IRA distributions. So this example of spray versus accumulate. If the IRA is distributed to a trust, the trust can accumulate some and spray some or distribute some to the beneficiaries. So in this example, we have $300,000 coming out of the IRA. The trust is going to pay $200,000 out, and it's going to accumulate $100,000. So the trust will pay tax on that portion. And with respect to the child, we're going to give the child $100,000 and each of the grandchildren $50,000. So we're taking this $300,000 IRA distribution and spreading it among 4 different taxpayers, tax brackets, to absorb lower tax brackets. Also, with the spray power, you can turn it on and off. So in year 1, we give the grandchildren $50,000. We don't have to give them money in year 2 or 3 or 4. And we can use a spray power to give unequal amounts. We could give this grandchild the whole $100,000 and this grandchild nothing. So the spray power is very flexible within a trust. asset protection with the use of a trust. If we have an IRA that's payable to a child, it is available to the child's creditors. It may be available to the divorcing spouse if they've commingled that distribution, and there is no asset protection available. Where if it's paid to a trust, we can use the trust as an asset protection vehicle from the child's creditors. There is a spendthrift provision that says the child's creditors cannot attach the trust. And because of the spray power, instead of distributing to the money from the IRA to the trust to the child who has a creditor problem, we would of course skip that child and give it to other children or grandchildren. This IRA money is not a marital asset, so it would be protected in the event that your child got a divorce. And so there is asset protection through the trust. So disclaimer versus spray. What happens where we have a disclaimer? The child is the beneficiary of this $2 million IRA. The child would have the ability to disclaim and say, I don't want $500,000 of the IRA, and by virtue of that, $1.5 million would be payable to the child, and $250,000 would be payable to each of the two grandchildren as contingent beneficiaries. A disclaimer is not flexible from the standpoint that it must be equal, and now the child and the grandchild dictates how quickly this money gets distributed. So again, if we had bad grandchild number 2, he or she could take all that money out, pay the tax, and waste the inheritance, where the spray power is both flexible because it can be unequal, and the trust controls the distribution plan. So here we have $100,000 that goes to the child, $50,000 to a grandchild, $10,000 to the other grandchild. We can have an unequal distribution. A trust can have both a spray power and a disclaimer power. So again, both disclaimer and spray can be in a trust, but a child can only have a disclaimer right. So this is going to be the new estate plan for large IRAs. And we have two really important decisions or questions that a trustee is going to have to make. And the trustee could be a corporate trustee. The trustee could be a uncle or aunt or other friend who you trust, or the trustee certainly could be your child. So trustee decision number 1 is, what's the appropriate tax result? Should I do a lump sum distribution? Should I take out 1/10 a year for 10 years? Should I do a lump sum distribution on the back end? So that's the first critical question the trustee is going to have to make, and this is going to be about minimizing taxes. Number 2 decision, should we accumulate money in the trust, or should we pay it out to the children and the grandchildren? And the answer to these two questions is that there is going to be a sweet spot between lower taxes and asset protection. The money that comes out to the children will be at lower taxes, but won't be protected. The distribution that's accumulated within a trust may be at higher tax rates, but it will be protected. So every child's going to have a different sweet spot. If we go back to the doctor client who's in the 37% tax bracket, what difference does it make if the trust pays the 37% or the doctor child pays the 37%? The taxes are the same, so they would want it accumulated because that provides asset protection if the doctor ever got sued. So I like numbers, and I wanted to examine what is the cost of accumulating the IRA distribution within a trust versus it paying to a child. At first glance, you would think it would be always better and lower to, to pay the IRA to a child at the child's tax bracket. So if you have a child doing married filing joint, they reach the 37% tax bracket at just over $612,000 worth of taxable income. A trust, on the other hand, reaches the 37% bracket at just over $12,000, $12,750. So one would assume that the trust is always going to pay a lot more tax than the child. And what I wanted to do is to see what that cost actually was. So what I did is I calculated we have $1 million in an IRA. One is payable to a child, one is payable to the trust. We let it grow for 11 years at 6%. That IRA grows to be about $1.8 million. And when the child takes it out, the child's going to pay $604,000 in income taxes, where the trust is going to pay just $664,000 in income tax. So at the worst case scenario, the cost of obtaining asset protection is just $60,000 in year 11. So I thought the difference would be much larger. This also assumes that the child has no taxable income. So I took advantage of all of that child's tax bracket. If in fact the child was in a 22 or 24 or 35% tax bracket, this difference would be substantially lower. And if you had the doctor child in the 37% bracket or the trust in the 37% bracket, the cost of asset protection would actually be zero. So again, trust will be very efficient. There is a cost for asset protection, but it's a lot less than I thought it would be. So kind of in conclusion, the Secure Act has dramatically changed how we are going to look at IRAs when someone dies. Do we want to pay it to a child? Do we want to pay it to a trust? What are the tax consequences? The end result is everybody will pay more tax under this rule and quicker, but we can still manage it. So trust will continue to allow a lot of flexibility, disclaimer provisions, spray provisions. Trust will provide asset protection, as we've talked about. And there will be a sweet spot for each of your children. And that sweet spot's going to be defined as where do we get the lowest income tax at the maximum asset protection. And what's going to be fundamentally important is income tax planning for your children. They're going to want to look at this on a year-by-year basis as they are beneficiaries of your IRA to, again, determine their sweet spot. Thank you for listening to this presentation. If you have any questions or you want to reach out to me, you can find me at jcornettit@cmrs-law.com.